What I would like to talk to you today about is the generosity of the Irish private pension system and how you can take full advantage of that. Okay, so hopefully there is slides appearing on the screen. So we're looking at the Irish pension system, unlocking the generosity. So when somebody first sat me down and explained the Irish pension system to me, and they brought me through the various reliefs, and when they mentioned employee contributions, AVC contributions got 40% income tax relief. When they told me that employer paid pension contributions were even better, they effectively also receive relief from PRSI and USC. Those employer paid pension contributions also qualify as a deduction against corporation tax. And then that the fund value grows fully tax free. My initial thought to that was that the release, are they too generous? Is the government actually giving away too much money here, right? So this actually is some information from that side of the house, from the government's view on what they're spending here. So this is from a wider report, right? Anyone interested in the all the detail? It's from the Tax Expenditures in Ireland report, October 2024. So somebody can Google that if they want the full detail. You're just going to get one graph from me, and this shows the top 20 tax breaks in Ireland, and pensions figure very substantially on this. So 1.154 billion for pension contributions. That would reflect the income tax relief I mentioned, up to 40%. The employer contributions, 956 million, another huge number. And there's even a third number down there, employer contributions for superannuation schemes, 323 million. So when you put the three of those together, you're getting 2.4 billion. And you can really see why they had to split that into three sections, because if they had just included it as pensions 2.4 billion, it would have been off the chart, right? So that is incredibly generous. So let's have a look at how you can benefit from that. So there are limits. Often people ask me, why do they have all these rules and all these limits? Well, I think from the previous slide, you can see the quantum of money that they're giving away already. So these limits are in place to prevent even more money going out there, right? And just when I talk about that 2.4 billion number, there's another massive pension tax break that isn't even included in that. And that's that your pension fund grows tax free. So that would be in addition to that 2.4 billion. So there really is a lot of money being given away here. So we're going to look at limits on employee contributions, employer contributions, and on the amount that you're allowed have in the fund itself, which would be the standard fund threshold. So just quickly on employee contributions, my examples, as I tend to age, my examples tend to age. So I'm just going to pick somebody age 50. Let's say they were on 100,000. They can contribute 30% as a pension contribution. So they contribute 30,000 and receive income tax relief of 40% on that, right? Just to look at that 40% relief in another way, right? When you put in a €100 contribution, your net pay only comes down by 60. Right, so because that 40% is the tax relief, so that 40 over 60 is a top up, and that's 67% top up. So when you compare that to auto enrollment, which is getting a lot of focus at the moment, auto enrollment only offers a 33% top up. So one message, possibly unfortunately for those organising auto enrollment, is higher rate taxpayers should actually avoid auto enrollment. So moving on to employer contributions, you'll see the quantum of money that an employer can pay into a pension scheme is incredibly generous. So if we go back to our 50-year-old example and they're on 100,000 salary, the employer could actually fund 200%. So in other words, they could fund 200,000 into their pension fund in certain circumstances. So that is an incredible amount of money. Now, that's going to happen in a limited amount of situations, typically where the employee is effectively the employer. By that I mean that they're most likely going to be a director and a shareholder of their own company if they're going to be looking at contributions to get near those limits, right? And as I mentioned, you're also saving PRSI and USC, so that's a €52 saving over 48, which is what you've forgone in your net pay. So that would be 108% top up. So very, very generous stuff. The standard fund threshold, this is also very generous. This is the amount of money that you're permitted to have in your pension fund. Right now, that's at 2 million. And it's actually set to increase by 200,000 per annum for the next couple of years. And in 2029, that would make it a total of 2.8 million. Right. So I mentioned that you get tax-free investment growth. So that would lead us to the question, well, where do you invest? So in broad terms, now I know Andy will have a lot of detail on this, so I'm just, just kind of setting this up just for the basis of how it relates to a pension. Your money can be invested in broadly five main places, the five asset classes. So the first one would be cash, the likes of deposit accounts. Second one would be bonds, when we hear about government bonds, be it German government bonds or Irish government bonds. The third place is equities. So you'd be hearing a lot about the S&P 500, American market, and of course the NASDAQ is very volatile at the moment. Fourth place would be property. Fifth place would be alternatives, the likes of oil. Gold has had quite a strong run as well in recent times. So they're in broad terms the five places you can invest. If you're at the lower risk end of the scale here, you would have quite a high proportion in cash and bonds, whereas as you're moving up the risk scale, the cash and bonds percentage is decreasing, the amount of equities is increasing. So just to have a look at somebody with a maturity value of 800,000, so we can just be thinking of a stereotypical 65-year-old. Their pension fund is worth 800,000. So how did they get to that number? What are kind of the building blocks that got them there, right? So up in the top right is that investment growth that's tax-free, all right? So in broad terms, you'd normally expect this to equal three equal amounts. So a third of the 800,000, about 267,000, came from that investment growth that was tax-free. Over on the top left side, they would have received immediate tax relief on their contributions. So that would have been tax relief at the point of entry. That when we looked at employee contributions at 40%, employer contributions effectively 52%. So that amount in the middle, that net contribution cost, that's the amount foregone in net pay. So that's really the amount it's cost them out of their pocket. About 267,000, about one third, to have a maturity value of 800,000. Now, that would be using an example of somebody contributing for possibly 20 years, because you do need a bit of time for that investment growth to take hold. So then just to look at their retirement options. So a quarter of that fund, quarter of the 800,000, 200,000, that is the tax-free lump sum. And then the balance of that amount, the 600,000, that is going to be taxable income. So we need to think of a few ways to minimize the amount of tax that is paid on that taxable income as it happens. So you would be obliged to draw down 4% of that ARF number. So 4% of the 600,000 is 24,000. You will be obliged to draw that down from age 61 onwards. But what you will find is that that is very much below your standard rate band of tax. So what we want to do here is create a situation where we're not paying high rate tax when you're drawing down your taxable pot of pension money. So looking at the standard rate band, so that just means the amount of money that you can have without paying income tax at 40%. So this is the amount that you pay income tax at 20%. So for single people, it's 44,000. So for a couple, you just multiply that by 2. So a couple can have 88,000 euro coming into the house and just be paying tax at 20% income tax only. For married and civil partners, it's still 88,000 is the total number, but you get a bit of flexibility there. You can slice and dice that number. If you have a higher earning spouse, they can earn up to 53,000 at the low rate. Lower earning spouse can be at 35,000, and you can hit 88,000. So when we looked at that 24,000 number coming from the ARF, and you even add the state pension of 15,000, you're up to 39,000. You still have a bit of room before you're hitting high rate tax. Now that might be taken up by rental income or dividend income. So just to have a look at the absolute fund maximum right now, look, there's not a huge proportion of people are hitting 2 million, but I actually have one on my desk right now, and I was kind of just looking at it with quite interest, knowing that this webinar was happening. So how that 2 million fund, and the person is age 60, right? So would you believe that the top right number, the ongoing tax-free growth, accounted for 1 million in his example of the 2 million? So the investment and the tax-free growth on it really, and the compound interest of that, really did the heavy lifting on that. So that means that the other 1 million was contributed, but on the top left corner, when we look at the tax relief of 52%, because this was mainly employer contributions, the tax relief on that was 500,000. So that middle box, that net contribution cost, again, that was net pay foregone over the years, was 500,000. So like that is an incredible way to turn 500,000 into 2 million. So in this case that's on my desk, the guy, he was age 40 and he had no pension. So he managed to achieve this in 20 years between age 40 and age 60. Now, contribution wise, he was getting 50,000 a year in there for 20 years. But like I say, a lot of that was, half of that was relieved through tax relief and contributions. So again, the net cost to him there was 25,000 per annum for the 20 years. So when we look at then retiring that, so a quarter of that fund is 500,000. So the first 200,000 tax free. The next 300,000 there is taxed at 20% only. So there would be a tax bill there of 60,000. So in this case, if you retire this immediately, you would see a lump sum of about 440,000 going into your current account within a week or two of submitting your retirement papers. The other 1.5 million that will be in an ARF, or in recent years could also be in a vested PRSA, forced to draw down 4% of that, that is 60,000 euro. Now, again, in this case that I'm looking at, he actually doesn't want 60,000 euro because he has rental income of about 40,000. So he actually only wants about 20,000. So what we can do in that situation is we can utilize the flexibility of the PRSA. So what we're doing here is, as a pre-retirement transaction, we are moving the money out of the master trust type based pension scheme that he's in and moving it into 5 different PRSA policy numbers. Now, he could have as many PRSAs as you want, but we just thought it was keeping it reasonably straightforward to have 5. So you can have a PRSA policy of 400,000 each, and then you can just retire these one at a time. So it gives you the ability to control the amount and timing of the retirement cash flows you're getting in retirement. So what we will look at doing here is we will retire the first PRSA, so the 400,000. He will get 100,000 of that tax free. The other 300,000, he will be forced to draw down 4% of that, which is 12,000. He actually wanted 20, so we'll dip into that PRSA and take out another 8,000 to hit that 20 number, to hit his standard rate band. Now, just to mention, all this plotting and planning ends at age 75, when all uncrystallized PRSAs must be vested at that point. But in this case, the guy I'm working with is 60, so he's 15 years of plotting and planning to do exactly what he wants. Now, anyone who knows, when they meet me, they know at some point I bring up the not so cheery subject of death, right? And what happens to my monies when I die, right? So here we are just looking at this in a post-retirement type product setting. So we're looking at the ARF or the vested PRSA. So again, going back to that stereotypical 65-year-old, he's drawn down his tax-free lump sums. The balance is a taxable ARF. So what happens when he dies, right? How does that work, right? So in normal cases, the ARF will go to an ARF in the name of the surviving spouse. Now, that doesn't create any new taxes at that point. There's no capital acquisitions taxes. There's a spousal exemption. So the spouse just takes over that ARF, or the phrase they use in the textbooks is the spouse steps into the shoes of the ARF holder. So, and then they're drawing money down as taxable income, just as the first spouse was. So then when the second spouse dies, they will most likely be looking to pass this on to children. Now, small bit of subtlety in how this is treated from a tax point of view. If the child is over age 21, there's no capital acquisitions tax, but there is an income tax at a rate of 30%. If the child is under age 21, there's no income tax here, but it is a taxable inheritance. So you are looking at capital acquisitions tax, and you're into threshold amounts that 400,000 can be received tax-free, and the balance at 33%. So there is a small little difference there. So the odd time, I mean, very much the norm is the ARF or the vested PRSA passes from one spouse to another and then to children. On a rare occasion, somebody looks at this, particularly maybe in a high net worth estate, and they might kind of be looking at that kind of going, well, when spouse number one dies, spouse number two takes it over, but they're probably going to be paying 40% income tax if we're dealing with high net worth people, and a bit of USC. So would it be better to transfer it to a child and get it into their hands at 30%? Because 30% is the lower number here, right? But look, tread carefully with that one, just worth mentioning it. So anyone who's done an ARF with myself, you will get a letter from me, and on that letter, I will give you two jobs at the end of the letter. One is that you need to contact Revenue and make sure that your tax credits and your standard rate cutoff point are communicated to the life assurance company, so that they know. The life assurance company, it's like they become your employer to the extent that they will send you a payslip and they will tax your money. So you need to have the right tax credits and standard rate cutoff point so that you're taxed correctly, right? The second job I give to people is I say, make an appointment, go into your solicitor. You probably have a will already, but now that you have an ARF or a vested PRSA, this would be a good time to go in, amend your will, specifically include this ARF in there so that it's very clear who is to get it on your passing. And also, as you're in with the solicitor, I'd mention, just bring up the subject of an enduring power of attorney. So just to mention, right, if somebody said, is there any way that there's no tax to be paid on the passing of an ARF to a child or whatever? I'm just going to mention there is a Section 72 whole of life assurance policy that could be set up by parents. So if this was going to happen, what you would normally see is both parents would set this up as a joint life second death. So that would mean nothing happens when spouse number one dies. When spouse number two dies, this amount pays out, and that amount can be used to pay the child's, be it income tax bill over age 21 or inheritance tax bill, without this whole of life payout being a taxable inheritance itself. Now, very good in theory. In practice, what you find is that the parent is obviously a bit older when they're going to go about this, so it can be a bit difficult to get that life cover. They're going to have medical ailments. It might be priced a bit more expensively, or in some cases it might be refused. But for now, it's just good to mention that it does exist. Now, a lot of items not covered today. I'm thinking if you were hearing this information up till now for the first time, it may seem tricky and complicated in part. It could have been a lot more complicated. There was a lot of items that weren't mentioned today. I just want to make you aware of them. And also, as I just quickly mentioned these, if there's any of these that you're interested in hearing more about, let us know. We could use that as a subject for a future webinar. So a lot of things that come across my desk. So people funding a pension, should they do it via master trust or PRSA? The answer on this changes depending on the year you ask me the question. If we went back 3 years ago, master trust would have been the answer. 2 years ago, due to changes in the Finance Act, they very much improved the PRSA to the extent that last year, if you'd asked me that question, I would have said a PRSA is a way to go. Then in the most recent Finance Act, they reined back some of the benefits of the PRSA. Now the answer is it depends. Now you might say it depends on what? It depends on what you're trying to achieve. Are you focused on trying to get as much money in as employer contributions as possible? That's going to be master trust. Are you focused on a debt and service payout that is the most efficient? That's going to be PRSA. So they're one that's a tricky subject and changes from year to year. Moving jobs. So maybe somebody gets fed up with their employer, they want to move on, they find a new job, they move from company A to company B. What should they do with that pension fund in company A? Right now, I'm going to say straight away, it doesn't tend to be a good idea to move it over to company B and we can go through that in more detail. So if moving jobs is about you getting fed up with your employer, redundancy or termination is your employer getting fed up with you. Okay, so this, if you go back, I suppose a number of years ago, redundancy was always seen as bad news. I would actually see that quite differently now. I would see redundancy and termination payments, for some people, it can be viewed as very good news. It gives them an opportunity to get tax-free cash. Statutory redundancy will be tax-free. Termination payment, there will be an element of that that will be tax-free. And within the various options and calculations, there's something called a standard capital superannuation benefit. And you can often get more money in that route by waiving a right to a pension tax-free lump sum. Now, I wouldn't be advising anyone to waive their rights to a pension tax-free lump sum, but it's something that we can go into in detail and look at your options. Early retirement, somebody can retire early. You can get at your pensions money from age 50. We could have a look at what that looks like. Choices at retirement. We just assumed everybody was taking their tax-free lump sum and going into ARF or vested PRSA. We did not mention today about the annuity. So that is also something that definitely needs to be considered at the point of retirement. Lump sums at retirement, we looked at 25% of the fund value. We ignored the fact that there is another calculation possible where up to 1.5 times your gross salary could be the way that you go about getting that lump sum. AVCs could be used to go to ARF, but beware, the balance would be forced into an annuity. But again, it is something to look at. We didn't look at defined benefit private pension schemes. Often what you'll find is, sometimes a scheme gets into financial trouble and the member is kicked out, and there's a figure that a transfer value that's given to him in a defined contribution arrangement. Sometimes the scheme is in good shape, but they'll still offer the person retiring at age 55 a big ball of money to come out of the defined benefit scheme and then go into their defined contribution arrangement. Right now, tread with caution, but it's something out there that happens. So there will be a few people even listening in today who are in that situation or have had that situation. So that's another topic that could be discussed someday. We didn't mention defined benefit public sector schemes. We didn't really mention the state old age pension. Plenty of change going on there. You don't have to take that state pension at age 66. You can defer that to age 70 for a higher figure. Now, another reason why you might consider deferring that, the state pension approach has moved to a new calculation method, or is in the process of doing so, the total contributions approach, where you need 40 years of PRSI contributions to get a state pension. So maybe delaying your state pension from 66 to 70 would allow you a couple of years to accumulate some more PRSI years. Pension adjustment orders, we didn't talk about people getting divorced and how that impacts on pensions. We spoke about death post-retirement, but we didn't speak about death before retirement. Now, we did that in a previous webinar, so feel free to look up our website there, April 2024, when we went into some detail on that. So my last slide, the items that we did cover today. Okay, so we spoke about your pension fund, how to save it, the tax reliefs available on your employer contributions. Make the absolute utmost use of those. Try and hit the maximum you're allowed to put in. How to grow it. We looked at, just talked in broad terms about the asset classes that you'll be investing in and how they will benefit from tax-free growth. We spoke about how to spend it, using your standard rate band of tax wisely, and considering for larger amounts multiple PRSA policies for flexibility and drawing down those cash flows. And we also spoke about how to pass it on, capital preservation for the next generation and what happens there.